The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, everyone. My name is Louis Holling-Parsons. I'm going to be presenting today's presentation. Now, let me just go to the right slide. So I'm going to be introducing ETFs for efficient portfolio investing. The subject areas now, which I've actually worked on professionally in the past. So let's get started. This is my background. I've been working as the editorial director for the Lazy Trader for approximately a year or two. I joined the Lazy Trader about 4 years ago. Before that, I was an 8-year veteran of banking, Bank of England. I was lucky enough to be very junior, but working on, among other things, the recapitalization of the banks in the UK and also the bailout of Greece. Later on, I joined some asset managers where I worked as an investment manager. That's led on to me trading and investing in a variety of stocks you can see on your screens. And then I've got a variety of qualifications. The qualifications actually allow me to advise retail clients. These are the people who know, in theory, the least about investment. Now, anything I say today is me highlighting, presenting something. It's not a recommendation to do something, but the knowledge I acquired actually does allow me to present what I'm going to be presenting today. Now, the Lazy Trader, which is who I work for, we're very much focused on helping novices. We're trying to introduce investment to people who would like to take control of their own finances, their own investments. We keep it simple. As a result, we try to educate our readers. That's basically trying to introduce them to different subjects. We highlight the latest trends, and then we'll talk about trading and investing. The two are very different. Trading, you're very much looking to make money over a short period of time. It could be minutes, it could be days, it could be weeks. Investing, you're applying the Warren Buffett approach, which is you're buying and holding for potentially years, months, even decades, but I mean, that's another subject. Disclaimer, I'll let you read that at the end. As you can imagine, as I mentioned, anything I say today is an opinion. I'm not by any means suggesting that my advice is necessarily to be acted upon, but it's there just to show you. Right, so these are the areas I'm going to be covering today. I'll give you a minute just to quickly read them for yourself before we go into the actual presentation. So let's get into it. Efficient investing, what is that? We live busy lives. There was a post on Google about 5 years ago where the employee said, so you expect me to do my job, go to the gym, clean my flat, and do my financial admin every day? And that post got an enormous amount of likes. We're so busy, when are we going to have time to invest our own money if we want to? So what we try and do in efficiency investing is actually to make it easier for you to have less to do. So with an efficient portfolio, you should only have to check it a couple of times a year. Also, if you're trying to invest your money by buying individual stocks, that means you're going to have to go through annual reports. You're going to have to check the trading updates, which can be quarterly. Sometimes you might get an unscheduled trading update, which is typically a profit warning. That requires time. Now, for someone who's starting off with a small portfolio, maybe £5,000, £10,000 or $5,000, $10,000, the return you're going to get per year may not be worth 10 hours a week. As a result, it's an inefficient way of spending your time. Very importantly, compounding is one of the single biggest contributors to performance. That means your ability to reinvest dividends, your ability to grow your portfolio through companies reinvesting in themselves. This is something that Warren Buffett talks about. You buy a good company, that company makes money, preferably cash, and that cash is reinvested by the company into new products, into growing, and over time the share price follows, appreciates, grows your wealth, grows your portfolio. Finally, and a central point of today's presentation, the ability of humans to actually outperform the market is limited. In the UK, we had a portfolio manager who did outperform the market for a substantial amount of time. someone called Neil Woodford. He then managed to lose a lot of people, a lot of money by essentially getting too big for his boots. So even people who have managed to outperform over 10, 15, 20 years, like Neil Woodford in the UK, eventually get it wrong. Now, some people like Warren Buffett do manage it, but they are few and far between. The majority of us struggle. This is where ETFs and index tracking investments are actually very attractive. Now, the difficulty in beating the main market indexes, I'm going to give you some examples. Firstly, the efficient market hypothesis. Now, this is something which I could talk about all day, and I don't intend to, but I would strongly recommend that people who've never come across this term, never come across this theory, go and have a look at it in their own time. The critical point behind it is that the share price of any company in the world today is reflecting all available information, all available public information. And therefore, any human trader who's trying to, or investor who's trying to outperform the share price or outperform the market by buying the share in advance because they think, I know something the market doesn't. It's your ability to do that is actually not very good. And this chart shows it. And what this chart is showing is at the moment that the information comes out in the public domain, which is around 0, the ability of a human to then add some value, to then sort of outperform the share price move is 0.5%. It's very, very small. A trader is not going to trade for 0.5%. An investor is looking for more than 0.5%. So the ability to actually speculate, to actually outwit the market is not very good. Now here's some quotes which I would allow you to just if you just read them for a minute, and I'll talk about them in a second. Now, the first quote is pretty self-explanatory. The ability of humans who are running funds to outperform the index, in this case, the S&P 500, and you could apply this to any of the major indexes, the FTSE 100 or Stocks 50 in Europe, is very limited, frankly, pretty awful. The second quote, I think, is particularly interesting. And what it's basically saying is that from the start, once you're starting your investment journey, if you're paying 1 to 2%, which is typically what active funds or managed by humans charge, you're at a disadvantage straight away. Now, William Sharpe is an interesting person because he created something called the Sharpe ratio. Again, this is not something I propose to cover today, but I would recommend you go and read about it yourself. But what I will say about the Sharpe ratio is that it's a ratio which shows the amount of risk you took to get the return you then the return you then received. Now, what's important here is you may trade or invest in a share such as Tesla, and you may get a 20–30% return in a week, a month, maybe a day, and you'll be very happy with that. 20–30% is fantastic. The problem is the amount of risk you took to generate that 20–30% return is probably far higher than the actual return you got. What I mean by that is Tesla shares are very volatile. They're all over the place. They're up, down 10–20%, sometimes in a day. And sometimes you'll get a situation where the shares will open up 10%, minus 10%, and will close up 10–20%. That's an intraday swing of 20–30%. You've got to be a very good trader to get that right, to be able to buy it at the bottom and sell at the top every day. So if you receive 20–30%, for example, trading Tesla shares, the Sharpe ratio could suggest to you that actually, for the risk you took, for the volatility that you get with Tesla shares, you should have expected to have made 30–40%. And so it's an important ratio. It essentially points out that actually taking risk, a lot of risk, is not necessarily required to make a good return. Sometimes taking less risk, less volatility, will still get a very good return. Now, this is a very famous bet that Warren Buffett made. Some of you may be aware of it. Approximately 10, 15 years ago, Warren Buffett bet against some hedge funds that a simple S&P 500 index, i.e. an ETF, for example, tracking the 500 companies in the S&P 500, would outperform a hedge fund over 10 years. Well, after 9 years, the hedge funds gave up, and you can see what happened. On the right-hand side, the blue column is the performance of the index over 9 years. The purple bars are the various hedge funds which try to compete against the index fund. You can see that one of them, got close. I'm not sure close is probably the best word because it's still 23% off. The red bar is the average of the hedge funds. Pretty shocking. Now, hedge funds are pretty bad investments anyway because they charge an incredible amount. I mean, a hedge fund can sometimes charge 5-6% just for you to actually buy into their hedge fund, just invest in the first place. And then on top of that, you're going to have annual management charges of 1, 2, 3, sometimes 10%. So hedge funds are basically the only person who gets rich of a hedge fund is the hedge fund manager. Us investors, we lose our money. But this is an example where these hedge fund managers, who in theory are supposed to be able to make money in both an up and a down market, because they can go long, they can go short, they were still not able to outperform the boring index. Now, the main advantage of ETFs, diversification can be attractive. Some people consider diversification boring, low risk. Well, I'm going to turn it on its head and say to you, would you not be happy owning all these companies? And more than that, and I appreciate 3 of these logos have the name of the company on that. These companies are so powerful, so successful, that I don't even need to give you the name of these companies. You will know that it's Apple, Shell, McDonald's, Louis Vuitton, Nike, Walt Disney, Google. Are you going to tell me that you're going to be unhappy having an ETF which is diversified across 100 companies, of which there are many other companies here which are attractive, which I've not mentioned or I've not put the logo here. Microsoft, an attractive company. We could also go AstraZeneca, some of the German car makers, Mercedes, BMW. These are attractive companies which don't necessarily feature. Hermes, the French luxury house. These are attractive companies. So if you buy an ETF, yes, you're buying a lot of companies, but among those companies are a lot of very attractive companies which are worth holding. Now, I've mentioned volatility, and please don't think that I hate Tesla. I actually admire the Tesla cars when I see them in the street. They're very beautiful. Now, that may not be the reason to buy one, but a lot of people in today's society base their decisions on physical beauty. Also, I have actually been in Tesla once, and I was amazed by the performance. I mean, I'm a biker, so acceleration is something I'm used to, and I was taken aback. Having said that, let's talk about the investment side. If you're a novice investor and you're starting your investment journey and you want to invest efficiently, you don't have a lot of time, the last thing you want to do is to buy something where you wake up one morning and it's down 30%. Tesla shares are incredibly volatile. And this chart here, it's the trailing 12 months, so the last 12 months. What I seek to highlight is what we call the peak to trough. That is, if we look at the highest point of the highest value the shares got to, which is in November 2021, to the left-hand side of this graph, and then we look to the lowest point, the trough, which was towards the end of May, there's a difference of 47%. That's an incredible volatility. Now, for an investor who's not used to volatility, if you wake up one morning and you see your shares, one of your holdings down 30, 40, 50%, you may be tempted to sell. There is some evidence out there that novice investors tend to panic sell, often at the wrong time. The point here is that it may not be efficient for you to be investing in something which requires you to watch it, because 1 minute it's up, the next minute it's down. And in fact, if you look at this share price, interestingly, at the start of the year, 12 months ago, it's actually only up, by the looks of it, I'm just looking at 10, 20%. That's not a lot, frankly, for the volatility you've had. On the other hand, this is the S&P 500. Again, the last 12 months. Again, you're getting some volatility, but the peak to trough here is only 22%. And that's quite incredible because you have to bear in mind the last 12 months, we've had two significant events. We've had a full-on war in the Western world, tank versus tank, man versus man, the invasion of Ukraine. And that has caused all sorts of issues. We've seen the spike in energy costs, gas in particular. The other event we've seen is the rise in interest rates. Now, we have had a rise in interest rates in the last 10, 15 years under Fed Governor Yellen, but the interest rates were in the order of 0.25%. They were every 2 or 3 months. They were relatively small. At the moment, the New York Fed or the Fed are actually increasing interest rates by 0.75 every month or every 2 months. That's a lot. And yet look at this stock market. We're down about 14, 15% for the year at the time of speaking. We have a peak to trough of only 22%. And don't forget that the S&P does pay you a dividend in the region of 1.5 to 2%. So for a novice investor, and I would recommend for any novice investor that you take 2 to 3 years before venturing into individual stocks in any big shape. What I mean by that is, if you want to play around now, go ahead. There might be a stock you think is a good idea. But I would start with ETFs and maybe have a few stocks on the side that you play around with and give it 2 or 3 years. After 2 or 3 years, you'll get used to volatility. You'll understand how shares work in relation to earnings, how they react to bad news, for example. This is a big point with ETFs. They cost virtually nothing. Now, if you remember one of the quotes from William Sharp at the start of this presentation, if on your investment journey, the first thing you have to do is to pay out 1 or 2%, that means it's going to take you an amount of time before you start earning. Well, look at this. S&P 500, arguably the greatest creator of wealth of any security out there on a long-term basis, is going to charge you 0.07%. If you look towards the bottom of the of each of these two ETFs. On the right-hand side, US Treasury bond. This is US government bonds. It's considered one of the safest investments in the world. Again, your ongoing charge is incredibly low. Interestingly, the safest bond out there is, or safest bonds out there, are actually German government bonds, German Bunds in particular, 10-year German debt. The reason for that is because German fiscal discipline, I'm going to generalize here, but Germans tend to be very disciplined. So when it comes to fiscal deficits, they tend to be on the cautious side. At the moment, America has been expanding its spending in a way which is, from a government perspective, which is fairly interesting. But because the American economy is so powerful, so big, the US Treasury bond or Treasury bonds are considered very safe. That's why I've highlighted it in this presentation. For an investor who wanted a balanced approach to their investing, so a bit of equity and a bit of bonds, these are the two that you should earmark very early on in putting in terms of your portfolio. But again, a cost of 0.0% is incredibly cheap. Avoiding opportunity loss. A key point of investing in the market is do not try and time the market, but ensure your money stays invested in the market. Now, why is that? We all try and buy low and sell high. We have some success at it, but are we that successful at it? Not really. There's plenty of studies out there which have shown it. Now, it's good to have it a bit on the side, have a bit of fun with a few stocks we trade with, and maybe some people have got lucky with cryptocurrency. The one thing I will say about people with cryptocurrency over the last 10 years, if you have been very successful, fantastic, well done. But are you going to be able to match that performance over the next 4 decades? Probably not. And typically what we see people who've been very successful is they tend to get overconfident and lose their winnings. So this is why being a bit more cautious, investing your money in a way where you're not trying to time the market, but you leave your money invested, is often going to be more efficient. And the reason for that is this. Compounding is, according to Einstein, the 8th wonder in the world, Albert Einstein, because the ability of money to create more money through reinvestment is something which is very, very, very powerful. And I'm trying to highlight this here with the Shell share price. And in particular, I've highlighted the 24th of February 2022. That is a date of the invasion of Ukraine. And the reason I've highlighted it is because coming up to the invasion of Ukraine, the word with oil was that oil was out, renewable energy was in. Now, the oil price was going up. But how many here could have predicted the war in Ukraine? Realistically, many of us, the first we really thought it could happen, if we did believe it could happen, was in November 2021, when the US government, through intelligence briefings, started to highlight unusual military activity, unusual Russian military activity around the border of Ukraine. Now, the point is, we go from a situation where coming into this period here, and even in the years before, oil is out. And then we come to a situation, so you'd have expected the shares to drift down over time. And yet now we look at the share price, having reached a relative high, managed to drop down and recover. Now, how many of us would have predicted that a year ago? Not many, I suspect. Now, if you'd invested in Shell shares here and held on to them, whether or not the shares had risen as they have here, you'd have been paid a dividend of approximately 3 to 4%. In the case of Shell, that dividend is paid quarterly. That means every quarter you can take the cash dividend and buy more shares, potentially in Shell or in another company. And here you're creating compounding. And this is where time in the market, allowing that money to work for you, is more powerful than trying to buy at the bottom and sell at the top. How many of us would have done that? Some of us may have, but not enough for it to be a viable strategy. Now, I've said industry rules. They're probably more guidelines, but I'm going to say they're rules because many of us who worked in industry have had to pass all sorts of exams. I'm a case in point. Some of you, if you look at the exams, will see my exams I passed are remarkably similar one to the other. The reason for that is due to the regulation change. I had to change, or I had to take a new exam 3 times. Each exam pretty much had the same thing, but just because a regulator decided that they wanted increased education of its employees, there's no difference in the exams I took. But in those exams, we were told this is how you should invest. And to be fair to those rules, what is attractive with them is that they ensure that for a novice investor who is likely to make mistakes, or they are likely to make mistakes, he or she is likely to make mistakes, you are not going to destroy your portfolio, you're not going to damage your wealth too much. And it's important because what we want for you as an investor, as a novice investor, is to invest for yourself over your lifetime. What we don't want is for you to invest over 3 to 6 months, maybe a year. Maybe you went big in cryptocurrency back in November when it was on a relative high, where it's showing signs of coming down, and now you've lost a substantial amount of your money. So these guidelines are to ensure that if you do start investing in ETFs, that if something does go wrong, you're not going to destroy your portfolio, and critically, you're not going to quit investing. It's going to take you 2 or 3 years to really figure out investing if you are a novice. You know, if you're someone who is not trained in this area, who has a life and who doesn't have the time to look at this in any great detail. So I'll give you a minute here just to read through some of the rules, and I'll comment on some of them. Some of these are fairly self-explanatory. You know, don't put all your money in one ETF. What I will highlight is third from the top, buying foreign markets in their own currency. The 3 major markets in the Western world are the S&P 500 in the US, although you could also quote the Dow Jones Industrial Average, NASDAQ also, which is technology focused, but also in the UK, FTSE 100. In Europe, it's the stocks 50 biggest stocks in Europe. Now, each of those major markets are actually traded in their own currency. The S&P 500 in dollars, sterling, the FTSE 100 in sterling, and the stocks 50 in euro. Now, if you're a UK-based investor, all your money's in sterling, and you buy the S&P 500 in sterling, you have no currency risk, in theory. The problem you do have is if sterling suffers against the dollar, you may have lost money, even though the ETF has gained or the stock market has gained value, because the currency has lost even more. And at the moment, sterling is approximately, I haven't checked it today, but it's in the region of about 117, 118 to the dollar. Well, a year ago, 2 years ago, it was around 130, 140. That's a substantial drop. So if you buy the S&P 500 in dollars, if you buy the stocks 50 in euro, but on the basis that you are a UK-based investor, you're actually hedging yourself against sterling weakness. So that's why I'd always encourage you to buy foreign markets in their own currencies. I appreciate that your broker will charge you some form of foreign currency charge. Be careful with that. Realistically, they shouldn't charge you more than 1%. If they do, I would change broker. If they start charging you 2 or 3%, that's highway robbery, get out. Another point I want to highlight is limit your ideas to 5% of your holdings. Ideas is you believe in a stock. And I'll give an example, Tesla. Elon Musk has managed to sell Tesla as a fantastic investment. They are good cars. But if you look at the value of Tesla versus the revenue they generate, the cash they generate, the valuation is off the chart. So if you're going to invest a bit on the side in individual stocks you like, just make sure you limit it to 5% of your portfolio. Maybe take 0.5% positions. That gives you a chance to play around with at least maybe 10. Typically, idea stocks, story stocks, brilliant story, I believe in that story, often go wrong. So you don't want to destroy your portfolio in your first year of investing. Finally, limit your holdings to about 30. Simple reason, if you are someone who's busy and you're looking for an efficient portfolio, you're not going to have time to really keep an eye on more than 30 ETFs. As we're going to see in a minute, half those ETFs, you don't really need to cover them because they're the main market ETFs. And these are ETFs you're going to hold forever. You might sell them a bit, reduce them a bit if they do very well, but essentially you're going to hold them. So that actually leaves the amount of ETFs you really need to watch to about 10, maybe 15. Now here I've produced a model portfolio. This is something I did for 4 years of my life. This kind of portfolio particularly I did a lot in the last year of my career because the bank I was working then, a private bank I was working for, believed in ETFs over stocks and shares. Now, there's a quote up there, investment is an art, not a science. That is because there is no one portfolio which will fit everyone. There is no formula, there is no equation. I am suggesting this portfolio, but some of you will not like this portfolio for your own reasons. During my career, some of the clients I would work for did not like tobacco, alcohol, weapons, because as far as they were concerned, they were damaging to society. Interestingly, defense stocks, which produce weapons, has had a bit of a change in the last 6 months. Namely, coming into the war in Ukraine, defense stocks were seen as bad for society. There's been some commentary in the last 6 months saying that defense stocks today, actually, maybe they are ESG compliant, which is environmental social governance, i.e. good for society, because they protect our democracy. Von Clausewitz, a German leader from yesteryear, once said that war is an extension of politics. The political system we have in the West is one of democracy. Now, if I drill down a bit more into this portfolio, you will see that I have quite a strong exposure to the USA, in the region of 32.5% from what I can see, which is the largest single country or direct country exposure. Some of the sector ETFs, which are the bottom of this portfolio, will also have exposure to the USA. But the reason I've allocated so much to the USA is because the USA is the single biggest creator of wealth in the world. It is the biggest economy. It's a capitalist country. Wealth is good in America. Wealth creation is good. Apologies. There's an expression which is often used in America to do with political policies which would be identified with left wing are saying they are un-American. Why? Because America is very much focused on wealth creation. If we drill down a bit below, you'll see I've put in the Eurozone companies, so the Stocks 50, for the UK, the FTSE 100. Interestingly, the FTSE 100 actually pays a much higher dividend than most other markets. There is a history of dividends in the UK, which there isn't in Europe and the US. Therefore, the FTSE 100, especially at the moment when, frankly, the companies in there are not particularly attractive, the fact that it does pay a high dividend still makes it a relevant stock market in the world. Then we come down to the sectors, and because I've kept this portfolio as simple as possible for a novice investor, I have chosen sectors which, in my opinion, are sectors we're always going to need. In today's world, we rely on technology. Healthcare is obviously important, utilities, consumer discretionary, industrial energy. These are things we're always going to need. That's why I've chosen these particular ETFs. Now, I have put an idea ETF in here. Clean energy, second from the bottom. This is an ETF which I have invested in and traded quite a lot over the last couple of years. And if you look at if you take the time after this presentation to go and look at this ETF, you will see that for a long time, it did nothing. And then for about 5 years ago, it suddenly started to get some momentum, it shot up, and now it's come down. And the reason is a lot of the companies within this ETF are former state utility companies. Utility companies pay good dividends. They do not grow their earnings in substantial manners. It's not like Google or Amazon, where year on year they produce incredible increases in revenues. I appreciate at some point those revenues will slow down a bit, but they are growth stocks. Therefore, iShares Global Clean Energy, people see it as a future of renewable energy. That's fantastic. But actually, the stocks within it are not growth stocks, they're dividend stocks. So it's something to be a bit careful. This is why I warned you earlier on this presentation. Be careful with idea stocks. Now, I've included in it here and here as slightly devil's advocate, and also because I wanted to mention what I've just mentioned. Finally, emerging markets. It does actually include China. Some of you here will mention, may I inquire why I've not included China? I don't like China as an investment. It is the second biggest economy in the world. There are some fantastic companies there, and some of those companies have grown enormously over the last 5-10 years. But no investment, no company can prosper unless there is a stable legal framework supported by an independent judiciary. China today is pretty much a dictatorship. Even the Communist Party is no longer really in control. It looks like President Xi is basically running a presidential dictatorship. And we've seen that over the last 6 months to a year, where President Xi has said, right, you big tech companies, Alibaba, Tencent, you've made too much money, you've got to help society. And we've seen what's happened to the share prices. Now, some of us here might say, well, actually, that's a good cause, and I would agree. But the truth is, his campaign was more about control than actually redistributing wealth. Finally, and arguably probably the most important in this portfolio, look at the average cost. Look how much this portfolio is going to cost you to run each year. 0.26%, that's nothing. And this is a point behind efficient investing. The 32.5% you have in the US allocated at the top, that's going to be your wealth creator. Over 10 years, that is going to create wealth for you. 10, 15, maybe 20 years, but it's going to create wealth. Your UK-centric markets probably won't grow as much, but you're going to get some very attractive dividends. And then your Euro-based markets are going to be somewhere in between. They do pay a more attractive dividend than the US ETFs do. Part of the reason is in America, there is a culture of buybacks, not dividends. It's just how the US market works. So to have a portfolio which is going to grow your wealth, and the top half of this portfolio, you basically don't need to do anything. You don't really need to monitor it. It's incredibly efficient, and it's going to grow your wealth with you doing very little work. Now, nothing is perfect. Swiss stocks. I could have chosen another country, I could have chosen some of the Nordic countries, but the point is this: not everything is perfect. My portfolio does not include these companies. I'm sure many of us here have had a Nescafe in the morning or Haagen-Dazs ice cream at some point in their life. Equally, many of us have probably admired at some point in our life a Cartier watch, a Piaget watch, Jacques Lecoultre, Van Cleef, etc. Richemont, which owns all these brands, is listed in Switzerland. And then we come to Roche and Novartis, pharmaceutical companies. I suspect that every one of us on this presentation or watching this presentation has at some point used some of their products. Now, there is a Swiss ETF out there. I just chosen not to include it in this presentation. But the point is, this is where investing is an art, because not everyone's going to agree in my portfolio. Some of you are going to think, actually, I want Nestle. It is a fantastic stock. And that is your ability. You could quite easily remove the clean energy ETF, or maybe one of these sectors, or maybe you reduce the allocation I've given to some of these main market ETFs down to 5, 6, 7%, just because you want to include a Swedish ETF, a Swiss ETF, or an ETF from China, for example. There is a China ETF, which is only for the large companies, such as Alibaba. You also have, interestingly, a China ETF, which is only for companies who actually do business in China. That can be very interesting because those companies are likely to grow very quickly with the way that China, over the long term, because in the short term, things in China are not so brilliant, but the longer term, China is going to transition to a consumer economy, which is going to create wealth. Now, how to get started? I would always suggest looking around these three main providers. There are others. Invesco in particular is a big one from the US. Have a look around all of them. If you get interested, have a look at industry publications. They will show you other ones which could be of interest. Wisdom Tree is another ETF provider, but these are the three main ones. iShares is the biggest today. Vanguard were actually the pioneers of ETFs, and State Street, SSGA, have come on the scene and are major. In particular, what's interesting is they tend to do things which are a little bit differently from these two. In truth, iShares is so big today that anything that SSGA has, iShares will tend to have it too. But one of the things you do want to consider is diversification. Now, in my model portfolio, I have used all three of them. Why? Because iShares tomorrow could have a problem, so you don't want every single one of your ETFs in iShares. So I've mixed and matched. You've got some Vanguard, you've got some SSGA, you've got some iShares. So when you get started, try and pick a few from all of them. Don't only stick to one provider. Now, each ETF will have a fact sheet, usually 2 to 3 pages long. It will tell you what the fact sheet is trying to do, the currency, dividends, and all sorts of information around dealing, including the performance. This is interesting because you can then compare what do you want. It will also include the top 10 holdings. So what companies this ETF invests in. Mix and match, have a look, and you can even compare the FTSE 100 ETF from iShares, this is iShares, to Vanguard or to SSGA. An important point is actually ensuring you can actually buy the ETF in the first place. The reason I mention that is some brokers will not allow you to buy an ETF if it's listed in a foreign country. Now, I'm based in the UK, so I've been a bit UK-centric here, but this can apply if you're based in Europe or in America. Your broker may not allow you, for example, if you're based in France, to buy an ETF listed in the UK. Now, if we are based in the UK, this is an example. We want to buy the FTSE 100, the main market ETF. Well, London Stock Exchange, fantastic. It's the main market in the UK, listed in sterling. Great, we can go and buy it. Now, we may want to go and buy the Stocks 50, the 50 biggest companies in Europe. We are British. We don't travel to Europe for our holidays. Maybe we just go to Cornwall. As a result, we don't really care about sterling losing value versus Europe because we never exchange any money. So we want to go and buy it in sterling. We've got a problem. We can buy it. It is listed on the stock exchange, but we're going to be forced to buy it in Europe. in euros, sorry. So when you do come to buy an ETF, just make sure that you can actually buy it. This dealing information will be available in the fact sheet. In fact, it's here, it's this particular box down here on page 2. So always have a look at this. And if you really want to go alternative in your investments, maybe you wanted to invest in Swedish stocks, well, then you're going to have a problem, because British brokers will not allow you to trade these two markets. The reason for that is to do with regulation. Any ETF has to have a fact sheet, and a broker in the UK has to be aware of, has to have knowledge of that fact sheet to allow you to then go and buy that ETF. And if a UK broker had to go and have every single fact sheet for every single ETF listed in Europe, they wouldn't have the staff to actually handle it. As a result, they just say, sorry, you can't buy it. So that's something to be aware of. Sometimes there'll be a particular ETF you want to buy, which is only listed in Europe, if you're based in the UK, or vice versa. You may not just be able to buy it, something to be aware of. Now, be careful what is actually under the bonnet. This is an example of the communication sector ETF, that's P500. And actually, you've got a 47% exposure to two companies. Alphabet is the holding company name for Google. You've got nearly 33% in Google and another 15% in Facebook. Meta is the recently rebranded name of it. And then if you look, your top 10 holdings represent 87% of this ETF. That's an incredible concentration. That may not be particularly efficient, because you're essentially basing that return from this ETF on two companies. If Google has a profit warning tomorrow, you're going to suffer. So just be aware what kind of percentages they have per company. Now, here's some tips for you to help you with your investing ETFs. I'm not going to cover all of them because I have discussed them today, but I am going to highlight the one at the bottom. Always understand what you invest in. Now, if you are new to this, or you have some experience but not a huge amount of experience, you may not understand everything, but at least have some understanding. Whatever you do, do not invest in something if you have no understanding. And even worse than that, if you look at something, for example, cryptocurrency, and you think, I don't understand how this is valued. Okay, I understand that if Elon Musk tweets about a particular currency, it's going to jump 50%. I understand that. But I don't know when Elon Musk is going to tweet. Therefore, if you do come across that kind of investment, that's a definite no-no. Just don't go there. So that's a critical thing. You always have some understanding of what you're investing in. As a novice investor, you're not going to understand everything, but be curious and find out. Nothing is perfect. When you own an ETF of a main market, of an index, you're going to own the bad stocks as well as the good stocks. So you're not going to get just positive. That's part of it, but over the long term, an ETF is a very efficient investment and it will grow your wealth. One area where ETFs are not efficient is with smaller companies. If you look at the performance of actively run by humans funds versus smaller company ETFs or benchmarks, active manager outperform. That is not to do with the skill of the active manager. That is simply to do because the active manager is essentially some form of quality control. An ETF or an index will have sometimes 150 companies, and it will be forced, as we mentioned in the line above, to have the bad companies as well as the good ones. Now, smaller companies have the ability to grow very quickly. It's not unheard of seeing a share price in a smaller company increase 100, 200% in a year. Equally, you can have a smaller company which basically goes bankrupt and the shares go down virtually to zero. Now, with an ETF tracking an index, a smaller company index, you're going to get those terrible companies. With an active manager who's running a small cap fund or small companies fund, they can choose, right, I'm not going to buy those bad companies. I'm just going to have the good companies, or at least the companies which are not terrible. So they're just avoiding the bad ones and benefiting from the brilliant ones or the good ones. So this is one area where a smaller company's fund could be of interest to you as opposed to an ETF for smaller companies. Finally, at the bottom, if you buy the S&P 500, you are, in some respects, buying a bit of a tech sector. As you can see here, 70% of the holdings, the top 10 holdings are in tech. If we were to look down the remaining 490 companies in the S&P 500, you're going to find there's a lot more technology in there too. So again, if you're buying the S&P 500 and the tech sector has outperformed, as it has done over the last couple of years, you may find that the S&P 500 as a stock market drops just because a subsector within it, technology, has been selling off, has been repricing into a new environment, such as increased interest rates. Other ideas. Some of you actually may be older investors who are looking to retire or retiring soon. Therefore, dividends are more important, income is more important. There are ETFs out there which will focus purely on dividends. So typically we're paying 3, 4, sometimes 5%. Within the major business sectors, there are subsectors. Within the tech sector, you can have semiconductors, you can have software companies. Within pharmaceuticals or within the healthcare, you can have pharmaceuticals, you can have biotechnology companies. There is all these possibilities which are at your hands if you want to invest in them. Countries, I've talked about China, Nordic countries can be interesting. One of the excellent oil companies in the world is actually listed in Norway, and it's going to escape my mind. I forget the name of it, but it is actually the Norwegian state utility company, and they have been major actors in getting involved in wind turbines. So they do produce oil, but they're also way ahead in terms of having wind turbines. In fact, they're way ahead of Shell and BP on this. Finally, there may be some ideas you want to get involved with in the crypto space. Everyone talks about cryptocurrencies, but then you also have blockchain. Blockchain is often seen as the one thing out of the crypto world which will be around in 5-10 years' time. There is an ETF out there which you can invest in blockchain. So again, there are many other possibilities apart from main market ETFs. Conclusion, I've essentially highlighted what I've talked about today. What I would say to you is, if you are a brand new investor, get involved, be curious, but give yourself 2 or 3 years before you really give up. Don't give up for at least 3 years, or before you really go big, before you start investing substantially in individual stocks. Just because you won't be used to volatility, you won't necessarily be used to how the market reacts to certain events for particular companies. If you've been around for 2 or 3 years, you would have seen it, and therefore you'll be better at not only handling it if it goes wrong, but critically not making the mistake in the first place. So thank you very much. That was the end of my presentation. If you have any questions, please feel free to ask, and I will do my best to answer them.